What if I told you I made over $500,000 using a single ICT trading model, but it's systemized so that anyone can copy it? After years of backtesting, refining, and live trading, I've finally developed a framework that's easy to learn and execute, easy to digest for traders at any level, and it's proven to have over a 70% win rate if traded correctly. So today, I'm giving you the exact 5-step model that I use daily in order to take high probability trades that earn me over $500,000. So if you miss this, you'll keep overcomplicating your trades while watching these wins slip right past you. So let's get into it. The first step before you do anything is to determine your higher time frame trend. This basically means we want to understand where the market is moving on the higher time frame so that we can align that for our lower time frame entry. And the majority of traders skip this step. They'll jump into trades without knowing if the higher time frame is bullish, bearish, or just consolidating. And this leads to many things like inconsistent profits where they'll take one win and then they don't even know why, or they take a loss, they don't even know why. They'll overtrade and second guess because they really don't understand where the higher time frame is going, and they'll get manipulated out of trades and just become liquidity because again, they don't know where the higher time frame is going. So if you're not checking this higher time frame, you're literally just trading blind. That's why before I even think about placing a trade, I ask myself these two questions in order to determine my bias. All right, so these are the two questions I ask myself in order to determine my higher time frame bias. The first one being, are we delivering from buy side or sell side liquidity? Then the second one is, are we respecting or disrespecting for value gaps, right? So if we are going to be bullish, we are delivering from sell side liquidity, we're disrespecting bearish gaps, and we're respecting bullish gaps. We're going to be bearish, we're going to be delivering from buy side liquidity, we're going to be disrespecting bullish gaps, and we're going to be respecting bearish gaps. So I'll draw this out so you guys can have a picture of what this looks like, right? Again, if we're going to be bullish, we're going to be delivering from sell side liquidity, right? This is a sell side liquidity pool here. Let's say this is previous day low that we just swept, right? So we just swept out previous day low, and then we're going to be disrespecting bearish gaps in this leg, right? So we'll probably have some sort of bearish gaps get created here. Then if we start disrespecting this is a sign in a bullish order flow, right? Especially when also we then start respecting bullish gaps here, right? So we're disrespecting bearish, and then we create bullish gaps along the way, and we start respecting bullish gaps. If all these three things is happening, right? We are delivering from sell side liquidity being previously low, we are disrespecting bearish gaps, and we're respecting bullish gaps. And again, disrespecting gaps is just when we get a body closure above a bearish gap, and then respecting gaps is just when we wick it and then we trade away from it. So if that is the case, and then we have a clear draw on liquidity higher, the market's most likely going to trade higher, and that's a bullish bias. Okay, and then if I'm going to be bearish, I'm going to ask myself the same questions, right? So are we delivering from buy side or sell side liquidity? Well, if we have a move like this, we're going to be delivering from what? Buy side liquidity, right? So boom, this is your buy side liquidity pool here. We're going to be sweeping out these highs, and then we're doing what? Well, we're probably creating some sort of bullish gaps along the way when we sweep out this buy side liquidity. So if we start trading through that and getting bodies closing below this is a sign that we are disrespecting bullish gaps, right? And then if we trade back into this gap here that gets created, and then we respect it and trade away from it, then this is a clear sign on the higher time frame that we are going to be going for these lows, right? So this is a bearish bias, right? So these are the questions you have to be asking yourself. Again, if I'm gonna be bullish, we're gonna be delivering from sell side, we're gonna be disrespecting bearish gaps, and then respecting bullish. That means the draw on liquidity and price is most likely going to go higher. And then if we're going to be bearish, we're going to be delivering from buy side liquidity, we're going to be disrespecting bullish gaps, and then respecting bearish gaps. It means that the draw on liquidity is most likely lower. And this first step alone, actually finding your higher time frame bias, filters out so many of the low quality setups that I see with this model. But what I'm about to show you next is what actually sets up your high probability entry. So let's get into it. So step 2 is actually finding out where the market is going to be bouncing from. This gives us a clear level to anchor our bias and build an entry point around. But if you skip this, you'll keep missing out on trades that you think look good, and then you'll just get manipulated out, and then price will run to your TP. So let's hop on the charts, and I'm gonna show you how to find these key levels. All right, so how do you actually find your key level? So you want to be looking at the 5-minute time frame and higher. So the 5-minute time frame, the 15-minute, the hourly, the 4-hour, the daily, the weekly, right? And you're gonna want to be looking at these time frames for all of these key levels, right? So for value gap, at minimum, I need to see price be rejecting or bouncing off this key level being a 5-minute for value gap at minimum, right? We can also use a 15-minute, hourly, 4-hour. Also, this is not in any specific order. And then for intermediate highs and lows, right? So you guys know what a fair value gap is, right? If you don't, go to the ICT for Dummies video that we have in our PB trading bootcamp series, right? So go to that, you can watch that there. But for value gaps, right, we want to be rejecting off this 5-minute time frame or higher, okay? Then intermediate lows and intermediate highs, okay? This is going to be where we have a low that gets left inside of a gap, okay? Or a high gets left inside of a gap, right? And then these are great areas of rejection because there's stop losses resting here, right? So when price trades back to this, then we reject off that. That's going to be a great area. And this is a key level, this intermediate low. Or what the bear side looks like is an intermediate high, right? Which is just a high resting inside of a gap, okay? And again, this is at minimum minimum the 5-minute time frame. All right, at minimum, you want to see this being on the 5-minute time frame. We can also have 15-minute intermediate highs and lows. We can have hourly highs, intermediate highs and lows, right? So it's a 15-minute intermediate high. But yeah, next up, previous day high and previous day low. Okay, time-based liquidity like this is really, really good. Also previous week high / previous week low. Okay, so this is also a really good liquidity pool. Previous day high and previous week low, and then previous day high and previous day low. You can just do this by going on the daily time frame, and then you can see whatever the previous daily candle is. You can mark out the high and low of that, and the same thing with the weekly. You can just mark out the previous week high and low. So those are like key levels to be bouncing off for sure. And finally, we have London and Asia session highs and lows. Okay, so this is a great key level because oftentimes it is aligned with an intermediate high and low, meaning it is aligned with a gap, right? So oftentimes we do have like London lows here, and then it's aligned with a gap, which is a great area to be bouncing off of. But yeah, just overall London and Asia session highs and lows. If you guys want to get this indicator, it's ICT kills on the pivots by TFO. I have a video going over all of my indicators, so go watch that if you haven't done so already. But yeah, this marks out London and Asia session pretty well for you, so you can just look at this. And again, these are great draws on liquidity, as well as areas to be bouncing off. Oftentimes we hit this and then we end up reversing off of that. But yeah, those are your key levels. These are your main key levels that you want to be focusing on for this model. All right, now you're set to not be trading blind anymore. But if you want to take things even further and trade with this model in live time and get one-on-one mentoring, then click on the link in the description below. You'll get access to all the tools, frameworks, and strategies that I personally use, the same ones that's helped people like Jake earn his first 2 payouts, as well as people like Fletcher, who's only been in the community for 2 months and he's already gotten 2 payouts, and even people like Solace, who's already gotten 5 figures worth of payouts this month. These are real people, real results using this exact model. So let's get into step 3 now. So now it's time to see how price actually reacts off of this key level. Most traders just mess this part up because they can't understand where the manipulation happened at that key level, and then they'll take the trade, get stopped out early, and then watch the trade happen without them. So let me show you how to actually identify this manipulation. Okay, so how to actually identify your manipulation leg. You want to mark out the low to the high that hit your key level, or vice versa, the high to low that hit your key level, right? So if we're looking at, a chart like this, right? And let's say your key level is this sell side liquidity pool right here, right? Let's say this is previous week low. Okay, we hit previous week low here. Okay, this is going to be your manipulation leg, right? Once we get displacement from there, right? This is going to be your manipulation leg, this high to this low. Okay, so right here is your manipulation leg. So that's how you actually mark it out. Now it's just a swing high to a swing low. And then the same thing if we are going to be bearish, right? So let's say we're going to be bearish, and let's just say that this is our key level here, right? Let's just say it's this gap right here, right? Let's say we have a bearish for rally gap that's formed here. Boom, we hit it there. Okay, so let's say we hit this bearish for rally gap and then we get displacement from that. To actually identify your manipulation leg, you want to be looking at the low to the high that hit that key level. Okay, so the key level here, let's say, is this 15-minute bearish FVG. Okay, and we want to look at the low to the high that hit this. Okay, now this is going to be where your manipulation leg is. This is the manipulation. This is the false move up before we actually trade lower. Okay, so this is actually how you identify your manipulation leg. You're going to be looking at the swing highs and swing lows that hit your key level. Okay, so now that we have identified our manipulation leg, right, we want to be looking now at the inversion for value gap to actually take our entry from. Okay, so we're going to be looking at the highest time frame for value gap in this leg, right? So we have this leg here, right? And we're going to be looking at this for value gap, right? So we're probably going to have a for value gap that gets formed here after hitting our key level, and we're going to be looking at the 30-second time frame and above. So the 30-second all the way to the 5-minute. Okay, so let me write this down. 30-second to 5-minute for inversion for value gap. Highest time frame. Okay, so you need to be using the highest time frame, meaning what? Okay, so we might have a 1-minute for value gap in this leg. We might also have a 2-minute. We might also have a 3-minute. Okay, so if the 3-minute, and then let's say there's no 4-minute, let's say there's no 5-minute. If the 3-minute is the highest time frame, then this is the inversion that you want to be taking. You want to be taking this when we get a body closure above this, and then you can take your entry. Okay, same thing here. Let's say this, and let's say this was like a 3-minute. Okay, now same thing here. Let's just say the highest time frame here is the 1-minute. We didn't have a 2-minute for value gap in this leg. We didn't have a 3-minute. We didn't have anything, right? So the highest time frame was this 1-minute. So you just take that 1-minute IFG right there. Once we get that inversion, once we get that body closure, so that's actually how you identify the highest time frame. Okay, so you need to be identifying it like that. Now step number 4 is the most important. It's where the most amount of money is made, but it's also where the most amount of money is lost, because I see it all the time. Traders will see their entry model, but then they don't actually know what to target. So I'm going to go over my favorite draws on liquidity in the market, so you can actually have these target points so you can actually exit your trades. So let's get into it. Okay, so these are all of the best targets that I use in order to exit my trades when I'm actually taking my model. Okay, so I have 8 of the best targets that I use every single day. This is really in no specific order, except for the unfilled 5-minute and 15-minute gap is by far my favorite target with this model, and it's the one that honestly makes me the most amount of money. But let's get into it. Okay, so first off, we have relative equal highs and lows, right? So this is just simply when we make a high that doesn't sweep out the other high. This is a relative equal high. Then this is a great draw on liquidity for price to then then go back to, right? Because people see this as resistance in the market, but then there's going to be a lot of stop losses resting here. And then we as smart money traders can just target that. Next up is equal highs and lows. That's pretty much very similar to relative equal highs and lows, except for equal highs and lows is just exactly equal, right? So this is even a stronger draw on liquidity and a stronger target. So pretty much same thing there. And we have low resistance liquidity, which is when we end up generating sell stops or buy stops, right? Meaning we are generating these highs, right? So it's kind of like relative equal highs, but there's just a lot of them now. So now there's a lot of stop losses resting. So now we have a lot of relative equal highs. And then these are great targets to just get ran through. And usually these moves happen really, really fast, right? So when we have like a lot of low resistance liquidity, these moves happen pretty fast. Then we have fourth, previous day high and previous day low. I showed you guys what that was, right? So that's not only is that a great rejection area to have to be bouncing off of, it's also a great target. We can target this previous day high and previous day low. And then fifth, we have new day opening gap and new week opening gap. Okay, so the new week opening gap forms just every Monday, right? So every Monday, typically we will see some sort of gap happen. We'll just have like a gap up and you'll see like a big imbalance in the market, right? So this usually happens, again, this happens on Mondays usually at 6 p.m. So just look at that. Usually we do have some sort of imbalance in the market. And that's a great area that price likes to trade into. Next up is London and Asia session highs and lows. Again, I went over that in the rejection area, right? So again, the same way we can see price reject off these levels, it's also a great target to be targeting London and Asia highs and lows. Okay, next up is the data wick. So the data wick actually forms for high impact news days. Okay, so you want to be going on forexfactory.com, and on forexfactory.com, you'll see red folder news tips. So anytime we get red folder news, this happens, you know, PMI, whenever Powell's speaking, really the main one's gonna be like CPI, PPI, FOMC, NFP. But on those days, right, when you see CPI, PPI, on these days, CPI, again, CPI, PPI, FOMC, NFP, anytime Powell speaks, yeah, pretty much those days, you'll most likely see a huge news candle. It's just like a data wick, meaning you'll just see a candle like this, then we'll get just like a huge wick that just looks like abnormal. And if you see that happen, there was news at the time, let's say there was like 8:30 CPI news, this is gonna be a great area for price to then trade back to, because this is just seen as an imbalance in the market. Not a lot of orders got filled here. We're gonna go back, hit that high, or continue trading higher. But that's just a great draw on liquidity and target to have. And then my favorite target of all time is going to be the unfilled 5-minute or 15-minute fair value gap. Okay, so when we have a fair value gap that is unfilled, right? So let's say we end up creating a gap here, right? We get a huge run up, we create an unfilled gap here, we don't trade into it. If price ends up hitting key levels that we talked about before, let's say we hit like a bearish 15-minute gap, then we get, you know, our inversion, we identify the highest time from here, right? This is a great target to have. Let's say there's an unfilled 5-minute or 15-minute fair value gap. Really, really solid target. It's called my mechanical model, and this is what I'll go over in a second, and I'll show you guys some examples. But yeah, just absolutely like my favorite target of all time. I use all these targets every single day, but my main target for my mechanical model, and the one that honestly makes me the most amount of money, is the unfilled 5-minute, 15-minute gap. That's pretty much everything though. The final step is just now executing with precision. But believe it or not, a lot of people actually mess this step up because they don't know where to place their stop loss, and they forget to place their TP. They don't know whether to enter off a market order, a limit order. So I'm gonna be covering all of those things right now. So I'm now jumping into some real-time examples so you guys can get an actual understanding of how this works with all of the pieces put together. And I'm actually going to be showing you guys some trades that I have taken. Okay, for example, I'll show you guys the trade that I ended up taking today on Monday. Okay, so this was a really obvious trade, right? We had low resistance liquidity, right? We had all of these failure swings, we had relative equal highs here, right? So this is a great target. First things first, right? We want to identify our higher time frame trend, right? That's the first step. So the higher time frame trend on today and this day, again, very bullish, right? We're clearly trending higher, right? And again, higher time frame, don't fade this, guys. You never want to fade the trend. The trend is your friend. Okay, so very bullish here. Okay, so that's the first step. Now what's the second step? Finding the higher time frame rejection level. So the rejection level and our key level that I see here is this 5-minute fair value gap that gets created. So this 5-minute gap here is aligned with what? With our higher time frame prices, right? With draw on liquidity, with our higher time frame trend. Okay, so this is really good having this 5-minute fair value gap. That's our key level here. Now next is going to be identifying the manipulation leg. Okay, so the manipulation leg is the low or the high to the low that hits this key level. Okay, so this is our high, this is our low, this is our high, so this is our swing high, and then this is our swing low. So this level here, this area, this is going to be where I want to see the highest time frame inversion happen. And at this point, right, I'm also looking at the targets, right? So my targets here again are this low resistance liquidity, and then this is also what? Asia highs. We also have Asia highs here. So session liquidity as well, right? So really good. And then this is also a intermediate high, right? So this is a high that's resting inside of what? A gap, right? Remember we talked about this. So this is also a great draw on liquidity. And then this is also, what do we have higher than this? Previous day high, right? If we look at the daily candle here, we have previous day high right here. So all that being said, we have great targets, being this low resistance liquidity, being this 15-minute intermediate high right here, all right? Being also Asia highs. Okay, so this is your Asia highs. And then we have previous day high / all-time highs. So beautiful. Now we identify the highest time frame inversion in this leg. We've identified everything, and now we are ready to take our setup, okay, and take our trade. Okay, so here we end up waiting for the inversion. Again, this is the highest time frame because is there a 2-minute? No. Is there a 3-minute in this leg? No. Is there a 4-minute? No. Is there a 5-minute? No. So the 1-minute here is the highest time frame. So I'm entering long once we get a body closure above this bearish for rally gap. So on this candle, is this an inversion? No. Is this an inversion? No. Is this an inversion? Yes. All right, because we got a body closure above this, and then I can place my stop loss here. I can also place it at the swing low. For the, honestly, the swing low is always going to give you like the most room to breathe, and it's going to be like the highest probability. But I've been trading for a while now. I know the highest probability areas where a price is most likely going to be either invalidate the trade. So for me, I can put my stop loss here, which is just this fair value gap low, meaning we could trade back down to here. And this is a bullish gap. So this should get respected if we are going to be bullish, right? This should continue trading higher from here. So I'm looking to see this be like the lowest point. I don't want to see price trade below this. At that point, if we go all the way down here, I don't want to be in this. And at that point, we'll most likely go to this low. So I'm gonna put my stop loss here at this for value gap low. Okay. Then you're gonna go break even once we take the internal high of the manipulation leg, meaning right here. And then you can TP at your draws on liquidity. And I look for a 1-to-1. So my draws on liquidity revolve around a 1-to-1 to 1-to-2 to 1-to-3. If you look at all my trade recaps, they're pretty much around that, about a 1-to-1 to 1-to-3 area. So that's what I'm gonna be looking for. So I have a draw on liquidity that's really obvious here, honestly, Asia highs, and it's about a 1-to-1. So I can target that. I can also target higher. For the trade I took today, I just targeted this, but you can also target higher than this. Okay, so play this out. Boom, move your stop loss now to break even once we take that internal high, and then you can take full profit once we hit this high, or also when we hit all-time highs, which eventually happens right there. So yeah, that's one example. Okay, so now guys, here's an example of the MEC model. I actually took this trade on, this was Wednesday, September 10th, so like 2 weeks ago. You can check out the trade recap then. Okay, so this trade was a MEC model. Reasoning for that is because there was an unfilled 5-minute for value gap here. Also a 15-minute, okay? So again, first step is doing what? Finding the higher time frame trend, okay? So we're looking at the higher time frame trend here, and it's what? Despite the liquidity, right? We're very obviously bullish here. Why? Because we are respecting bullish for rally gaps. We are then disrespecting these bearish gaps, disrespecting these bearish gaps here to the left of us, right? So we're very clearly respecting bullish, disrespecting bearish, and we're doing what? We have been delivering from sell side liquidity right here, right? So we're delivering from sell side, and we are disrespecting bearish, and we are respecting bullish, meaning the drawn liquidity is higher, meaning I'm going to be looking for long, okay? So now I know that I'm looking for longs, I want to find the highest time frame rejection level. Higher time frame rejection level is what? Okay, so if we're looking at this here, right, I'm going to be looking at what am I looking at here, right? So I'm looking now the hourly for rally gap, right? So we have a bullish hourly bullish for rally gap here, bullish hourly bullish for rally gap. We have an hourly bullish for rally gap right here, right? So I'm now going to zoom in within this hourly bullish for rally gap to find the highest probability area where price is going to reject, right? Because we have this hourly. I can now zoom in lower to like the 15-minute and then also the 5-minute, right? And we see we have a bunch of these stacked lows here, right? A bunch of these lows, right? And a bunch of these lows here. So price is most likely going to run all of these lows and hit this 5-minute intermediate low, which is just this low inside of this gap, right? And this should be the lowest point in which price should hit, right? Because we have all these stacked lows here, and this is resting inside of what? Again, this hourly bullish gap here, okay? So I want to see this get hit, for then we can get a reaction off of this to then get some sort of longs, okay? So this is what I was waiting for. So now that we identify our higher time frame rejection level, I'm going to wait for price to then hit it. Boom. Now that we hit it, now what? We need to identify the highest time frame inversion in this leg. And then what is the manipulation leg, right? We have this high, and we have this low that hits the key level, okay? So now we have this gap that gets created here. And this is the highest time frame. Do we have a 2-minute gap that gets created? No. Do we have a 3-minute? No. Do we have a 4-minute? No. So while I'm also doing this, I'm going to look for my targets, right? So my target right here, the very obvious one is what? We have an unfilled 5-minute for rally gap, okay? So an unfilled gap is just when we have a for rally gap that hasn't been traded into, right? So a gap that has been traded into is, for example, this, but the gap that hasn't been traded into is this, right? So this is your unfilled for rally gap. So we're going to be looking from here, from these highs to this low that hit this. So we get the inversion for rally gap right here, right? We get our body closure above this bearish for rally gap. We enter longs right there. We've got a stop loss at the swing low, which is really important. We go break even at what? The internal high that gets created. And then we have a TP at the 5-minute for rally gap. And then you can TP there, or you can hold for a 1-to-1 if you want to be extra greedy. All right. But yeah, that's pretty much it. Now I'm about to expose some real sauce here. You can have all of these things. You can have the perfect model. You can be rejecting your higher time frame key level. You can have your bias, everything aligned. But if you don't follow these 3 rules, your win rate will tank. I personally lost a lot of money early on trading this model, but after years of backtesting, journaling, and refining my data and model, I finally found these 3 rules that boosted my win rate like crazy. So let me show you what they are right now. All right, so the first rule I have in play is don't trade against equal highs and equal lows and low resistance liquidity. Okay, what do I mean by that? Okay, so let's say we have everything we want to see happen, right? And then we have our manipulation, right? We have this move. If there are equal highs here, or sorry, equal lows here, or let's say we end up generating low resistance liquidity at our stop loss here, right? Before actually having our inversion for value gap, then this is going to be a invalid setup. This is not going to be a valid inversion for value gap because we have low resistance liquidity at our stop loss, right? So if we're going to try to take a trade, we're going to have low resistance liquidity here as well as equal lows, right? So this is invalid. You don't want to be longing against this. You want to wait until this gets taken out, right? So wait for this. Don't take that initial inversion. Wait for this, and then you can take your trade after. Okay, next up is only trading from 9:30 a.m. to 11 a.m. Eastern time. This is your New York AM session, okay? You do not want to be trading past these hours, and you do not want to be trading before these hours, okay? It's really, really important, especially if we are trading NQ, okay? Since I trade NQ1, I trade futures, right? This is when the volatility is going to be the best. It's when it's going to be the cleanest. Please do not trade this with Asia session. Don't try to trade this with New York PM session, right? It's just going to be a lower probability. You're going to have a lower win rate. So instead, to have the highest win rate, trade this from 9:30 a.m. to 11 a.m. Eastern, okay? And then finally is following the 4-hour candle. So what do I mean by this, okay? So if we are looking at open high-low closes and open low-high closes, you want to be on side of that, especially with 10 a.m., okay? So the 10 a.m. candle is extremely, extremely important, right? So let's say this is your opening price right here at 10 a.m. We have an opening price right here. Now, if we end up trading higher, hitting a key level higher, this is a key level higher, and then we have a low, we then have a low, right? This is an open, high, low, and then we're most likely going to do what? Close, right? We're most likely going to have a bearish candle on the 4-hour time frame. Now, if you're confused by this, you can go ahead and check out our candlesticks videos that we have in the ICT for Dummies and our PB Trading YouTube channel. So go check that out if you haven't done so already. I explain that more in depth there, but this is essentially what it means, right? Don't trade against this. You do not want to be taking longs after we have this move. Don't look for longs here just because we get an inversion, right? Because you're trading against the 4-hour candle. This is most likely going to get stopped out. Same way if we are going to be bullish, right? So let's say we have opening price here, all right? And then let's say price ends up opening. We then trade lower, hitting our key level. We then have a high. Then we're most likely going to have a high close, right? Because this is a bullish 4-hour candle, right? This is your wick, it's your body, and they're most likely going to close bullish. So don't try to take shorts against this, right? If the 10 a.m. is telling you we are bullish, then take longs. If the 10 a.m. is telling you we are bearish, then take shorts, right? Always be looking for what that 10 a.m. candle is doing because it's going to give you a very clear bias and it's going to give you that confirmation in your initial bias if you're correct, or if you're not correct, then it's going to not confirm that bias and you're going to have to flip it, right? So always be paying attention to that 4-hour candle, specifically that 10 a.m. candle since we're trading AM session. And that is everything you need to know about my trading model. And if you stick to these, you'll start seeing results right away. And this systemized ICT model has helped me make over $500,000. And if you take everything from this video and actually apply it, you can start seeing results like my boy Safai, who's made around $12,000 in the past 2 weeks in the 1%, $2,500 across his 5 accounts. Or my boy H, who just got his first 5 payouts. Or the homie Code, who just got his 5 Express accounts and he's ready to start making actual money from trading. So if you're interested in working one-on-one with me, Pat, or my student success coach, click the first link in the description below. And thank you so much for watching this video.